Hello, how are you doing today? I hope you're having a wonderful day. Today we're going to dive into a question that's on many buyer and sellers' mind when it comes to real estate. Who actually pays for the closing costs? It can be a bit confusing because there's actually closing costs on both sides. We're going to break it down though so you can see that there's some flexibility, maybe some negotiation and strategy when it comes to closing costs. So whether you're buying your first home or selling your property, stick around to the end to clear up all the mystery. So let's clear up first what are closing costs. Closing costs are the fees and expenses that come with finalizing the real estate transaction after you've done all your negotiations on the price and with the inspection and the appraisals done and everything. This is really cost at the title company. They're the costs that need to be paid to officially transfer the ownership, prepare the deed, record the deed, title of searches, title insurance, and then all the loan costs that come into play, like loan origination, any taxes or insurance from the seller, or prepaid taxes and insurance for the buyer. Now that can really add up quickly on either side. Ballparking, you can say it's anywhere from 2% to 6%, but that's a huge ballpark. It really depends on if you're the seller or the buyer, you're paying cash or getting a loan, and the purchase price, of course. So knowing who's responsible for these costs is key to avoiding any surprises when you get to that closing table and are ready to pay. So first of all, let's talk about the buyer side of closing costs. In most cases, the buyer is responsible for a large chunk, but the seller is too. After all, the buyer is the one taking out the mortgage, if you're getting a mortgage, so there are specific fees that are going to be lined up with that mortgage. You're going to have the loan origination fee, and they have a whole bunch of fees that are incurred because of the loan. And so that is why it costs more to get a mortgage. So then since the buyer needs the mortgage, then those costs fall on them. That's going to include lender fees, and of course the home inspection and the appraisal are both going to be their costs if they choose to do a home inspection. But beyond those standard fees, there's a few others. Now, if they're getting a loan, they're also going to have lender title insurance. So they can have issues with that. They could also have prepaid interest on their loan, because most loans, for example, let's say it closes October 1st. Sometimes they're not going to make their first payment until December 1st. That's 60 days of interest that the buyer really owes. And so the lender gets that at closing. So that's the prepaid interest. And then you're going to also have regular insurance, home insurance, and taxes that they're going to expect you to pay a whole year. And sometimes it's like 14 months. They want you to be 2 months and a year ahead. So that's a large chunk considering how much insurance and taxes have gone up over the last couple of years. It's not always set in stone, and there is some wiggle room over what the buyer can pay in between negotiations with this lender, the type of lender that they use, the type of loan that they get, and any negotiations between them and the seller, and that can change who pays what. Again, there's also seller costs. And what the seller pays is more about conveying the property and making it good for the buyer to buy. They revolve around the transfer of ownership. That is going to include, of course, paying off their mortgage if they have a mortgage on the property. They are also going to pay transfer taxes. Now, in the state of Arkansas, it's $3.30 per thousand of the purchase price, and that's usually split 50-50 between the buyer and the seller. And then there's also going to be any commission that the seller pays, either if that's just for the listing agent or for the listing and the buying agent. They're also going to have to pay for that title insurance, seller's title insurance, saying it's free and clear to transfer. Usually the seller is the one that pays for the title search, so they can get the title insurance. They're going to pay to prepare the deed, and then the recording of the deed is the buyer's responsibility. And then there's just a fee for the title company to do the closing and get all that paperwork in order. The most costly item on there is going to be the commission for the seller, versus with the buyer, it's going to be their down payment and any of their mortgage fees. So you want to keep those in mind when you're sitting down with your listing agent when you decide the price on your home, to make sure that you are getting enough money to pay off your mortgage or walk away and buy another home when you decide that price after all those fees. So you just want to keep that in mind, and your listing agent should provide you a net proceeds so you'll get a rough idea what those costs are when you start out selling the home. So here is a sample closing statement to give you an idea of what closing costs would be. The average price in Cherokee Village right now are somewhere between $160 and $180. So this was pretty close. This is $199,900, almost almost $200,000. Now this was a cash buyer, so their closing costs were only $1,679, but the seller's closing costs were $17,000. The majority again was the commission. That was almost $16,000. So a large majority of that was commission for the seller. Now the buyer also had to pay some commission, and then after that all they had was a $125 closing fee, half of those deed stamps and recording fees. So they actually had very little beyond commission. Now the seller's costs were also similar. They had that closing fee. The title search was $500. To prepare that deed was $100, and then they had the title insurance of $600, and then they had the other half of the title stamps, as well as to record a couple death certificates and such to make sure the title was clear. So that gives you an idea on a cash sale. Now on a mortgage sale, this buyer, now this was a lower price sale. It was only $100,000, but the buyer had to pay $300 in loan points, which is what you can do to buy down your interest rate. You can pay money up front to buy that down. They had an origination fee. They had to order their credit report. They had to get mortgage, electronic registration system, flood certification, mortgage insurance. When you have less than 20% into your home, 80% equity, you have to pay mortgage insurance because they're taking a risk on you. And then he had a premium for that, and then he had some prepaid interest. Like I said, that was about 1 month of prepaid interest he had to pay. And then they had to do a year of homeowners insurance, a year of property taxes. They also had to pay the recording fees, as I mentioned, and then half of the transfer taxes. And then they had still the other costs of change of title, which is a lender thing. They have to show how the title passed through the history to show that it was clear for a long time. And then the title insurance was split between the buyer and seller. And then the lender also charged a cyber technology fee, document services, and then the title insurance, as I mentioned, recording services, the search fee to the title search, that was a seller charge. So you can see that there's a lot more charges. And so on a $100,000 purchase, this buyer had $12,000 in expenses and the seller had $11,000, and that was on a cash sale. So you can see that it would make a big difference compared to that cash sale that she only had about $2,000 in expenses, or the buyer had $12,000 in expenses on a $100,000 less home. So having that mortgage is a huge difference. So now we're going to talk about negotiating closing costs. Here's where things can get interesting. In some markets, like a buyer's market usually is where you'll see the closing costs are negotiable. So you can, as a buyer, ask the seller to pay your closing costs, and that can sometimes shift the responsibility on the seller, so you can either focus on getting your down payment, or maybe you have to fix your credit, so that you're able to get the loan even though you don't have the money to get the transaction closed over to you. Now on behalf of sellers, I'd like to remind you that you're not actually paying for the closing costs usually. Lots of times they'll add it as an addition to the sales price. It's really the buyer just getting it financed, and they have to put it on the contract so that it actually can be paid out for the closing costs. Now they negotiate the price of the house and ask for closing costs, then obviously you're getting less. But most of the times when this is asked of a buyer for the seller to pay the closing costs, they are giving you full price because they know that they're already asking you to pay their closing costs. So then because they're able to do that, then they can actually go through with the loan. And then there's also some mortgages like VA, FHA, and RD where you don't have to have a down payment either. So on a seller's market, usually sellers aren't going to be as negotiable on that, and that would be where you'd see it added onto the list price and have that full price. If it's more of a buyer's market, there's going to be more room for negotiation where a seller is willing to pay that. Now a seller can do that right from the listing point too. They can advertise that they'll pay buyer's closing costs right up front, have their list price, and then usually it's in the remarks that the seller will pay the buyer's closing costs. So they're already prepared to do that and be ready for upfront negotiations, and then the buyer knows that they don't have to be asking for that on top of negotiation of the sale, and that the seller's prepared to pay for that. Now for buyers, did you know that there's assistance programs that can help you with your closing costs and your down payment? Like I said, there are those mortgages that you don't need a down payment, VA and RD, but FHA loans usually have a 3% down payment Plus, those loans tend to have higher closing costs, more along the 6% mark, where a VA loan is usually about 4%. But you can get assistance with both the closing cost and the down payment if you qualify for these programs. So make sure that you talk to your lender and see what programs are available for you as a buyer, whether you can get the closing cost assistance or the down payment, either one or both. And there's also a program called a mortgage certificate credit, which is basically an advanced tax credit they expect you to get that they can apply to your payment ahead of time. So because they'll know that you have a less tax burden, and therefore you can lower your monthly payment, or you can qualify for purchasing a larger or better home because you won't have such a high debt to income ratio. It's definitely something worth researching into, because usually these are grants and not something that you have to pay back, as long as you're in the home long enough that you own it long enough to make it worth the program to work. In the end, closing costs are just part of the real estate process and another way to negotiate. So when you understand who pays for what and knowing where you can negotiate can make all the difference. Whether you're buying or selling, it's important to know your options, and most importantly, to have a plan in place from the start. If you found this video helpful, don't forget to like, share, and subscribe for more real estate tips, and watch this video to get a guide to home selling that walks you through the entire home selling process. Thanks for watching, and have a blessed day.